Good afternoon, and welcome everyone to this wonderful hour that we have with Dr. Judith Rodin. Many of you are new to us today, and so you have quite a treat in order. Those of us who have been part of the Portfolia community for years have had an opportunity to hear Judith speak a number of times. And we're really thrilled today to have her with us today to speak about her latest book, Making Money Moral, How a New Wave of Visionaries is linking purpose and passion. Purpose and profit and passion as well, Judith. But before we turn it over to our conversation, let me tell you a little bit about the amazing Judith Rodin. Judith has been the first of many in many positions, the first woman. She's been a groundbreaking executive and really a transformer through her whole career. She was the first woman named to lead an Ivy League institution, and that was at the University of Pennsylvania. And she was the first woman to serve as the president of the Rockefeller Foundation. And Judith has had really an opportunity to create two groundbreaking fields. The first in resilience, and we've had an opportunity to have Judith talk to us about resilience in the past. And that second one was in impact investing. And so Judith's work at the Rockefeller Foundation really created and informed impact investing as we know it today. And Judith, I think in your new book, you're really marrying both of these fields, both impact investing and resilience, and really taking a new look at capitalism overall. So Judith, we could go on and on about her many books and articles and thought leadership, also co-chair of the World Economic Forum. But I want to jump right in today and welcome Judith here and really go deep in this phenomenal book you've just put out.
Thank you, Trish. It's great to be here with you and great to be with so many wonderful friends of Portfolia. So I very much look forward to the conversation.
Well, we've been talking about this book, for a number of months, and really to have the opportunity to go deep in this, and as a practitioner of the art of capitalism, I, like so many of us, are looking at this and saying, where do we go from here? We see so many areas now where perhaps we do need to reimagine capitalism. And that's what you talk about. And let's start there where you say it's really a time for us to rethink it. Milt Friedman gave us a view of capitalism, but moral money now can help us reimagine. What do you mean by that?
Well, making money moral happens when the bold world of finance, the bold world of markets meets the aspirational world of impact. And what we've seen over the years since the field of impact investing has both started and then broadened considerably as it has, is that it is redefining capitalism, both intentionally, I would say, and unintentionally. Intentionally, because it's challenging the notion that the only responsible entity, the only responsible outcome for the companies is to deal with the shareholders. And there are many other entities that really are significantly critical and that sustainable and impact investing pays attention to. For example, the employees, the customers, the neighbors, and indeed the environment. It considers the environment and all of the issues around natural resources to be an important stakeholder as well. So that is broadening our view of the purpose of capitalism. In addition, when you do double bottom line investing, when you really are investing both for purpose and profit, typically you're taking a longer term view. And it has been shown now in the past several years that taking that longer term view actually mitigates risk. And so it allows a fiduciary responsibility with regard to capitalism that people didn't imagine before, and is really showing that you can produce impact outcomes, produce sustainability outcomes, and turn a significant profit. So that is transforming capitalism. This is no longer a field where we talk about patient capital or concessionary financing. This has really moved to the mainstream of the capital markets. And I think that's very, very significant. There are over $30 trillion now globally of assets under management that in one asset class or another are part of this category.
Mm-hmm. Well, talk a little bit about who those players are. Yeah, because it's still expanded, right?
Mm-hmm. Yeah, well, in the book, we talk about three categories of players, but you're right, it has expanded. So the term impact investing was coined at a meeting at the Rockefeller Foundation Conference Center in Bellagio, Italy in 2007, when we brought a group of investors to a meeting, and we really posed to them the question, is it real to think that you could create a double bottom line? Could we really expect traditional investors like all of you to be willing to say, you will diligence for impact as well as doing your financial due diligence, and you will measure for impact as well as doing your financial metrics in the more usual way? And they were really excited by that, and they coined the term impact investing. At the time, we thought that was just going to be one asset class. And one of the things that we've seen that's just been explosive in this field, and it's where the asset managers are playing such a critical role, is that there's impact and sustainable investing in every asset class. In alternatives, we see it in venture capital, we see it in private equity funds, large private equity funds, billions of dollars being raised for sustainable and impact investing. We see it in new ideas around insurance-backed securities. We see it in securitization of alternative energy assets. So all of these in alternatives. But we also see it in fixed income. I mean, think of the explosion. Now it seems familiar to us, but the explosion of blue bonds to protect oceans, green bonds for the environment, whether it's forest restoration or whatever. And last year, we saw racial equity bonds being put together, a $2 billion one by Bank of America, $6 billion by Alphabet. We see gender lens bonds. So fixed income is a very robust category. And then the public markets, public equities, whether it's an ESG rated company or an ESG rated fund of funds. There are many, many alternatives. This is being driven by the first category, which is the asset owners. And we have seen amazing and interesting activity on the part of the large pension funds, the global countries. It started with the Europeans, the Scandinavians primarily, really wanting to focus on this area. But it's grown to many, many pension funds all over the world, sovereign wealth funds, and of course, endowments and private wealth investors. And they are pushing the money managers. And that's what's really become interesting. They choose money managers who they think have a real product in these fields and a real capacity to deliver. They hold them accountable through metrics, and they threaten not to reinvest in their funds if they see any sign of ESG washing or greenwashing, or and there is some of that going on, and they're very, very vigilant about that. Well, and then the third category is what we call the problem solvers. And they are in the public markets or the private markets, but the for-profit entities who are the entrepreneurs and the companies who really have products, goods, services, business models that are trying to have impact in social or environmental issues. And then the second category may surprise some of you, but they are really the nonprofits. We are seeing tremendously interesting things going on with governments and with large NGOs. And I know we'll want to talk about some of those examples later because they're really compelling. And what the problem solvers bring to both the asset owners and the money managers is their very deep experience, their real understanding of what a social or sustainable product or good or service looks like, some sophistication around metrics. And so this matching between them has gotten really exciting and important in order to produce a really significant outcome, both on the impact side and on the profit side.
Mm-hmm. You know, I was just rereading your book last night, Judith, and I mean, there's some real complex and sophisticated ways that people are tackling these, you know, issues that we're dealing with, of climate and other. Can you give us an example of one of those? Kind of take us deep with, you know, one of those partnerships, how it's been put together, the impact of some of the work that you've been studying.
So this has been a great time for us to really have access to the CEOs of some of the largest pension funds, the largest money managers and the like, who might not have been available, except that we got them on Zoom. So we have tremendous cases with really rich and deep data around how they're doing it. I'll take one example in the climate area, and that was Pension Denmark, which has $41 billion of Danish funds under management for pensions for the Danish population, wanted to get into sustainability and environmental investing. This was around 2010. And so they looked for a partner within the Danish ecosystem, and they found Denmark Oil and Gas was trying right at that time to convert to really being only an alternative energy company. And the two decided to come together and co-create a vehicle. The company changed their name to Ørsted, not wanting to have oil and gas in their name. And they created a product which gave guarantees to the pension fund, who were the investors, that if the price of electricity using the alternatives fell below a certain number, Ørsted would guarantee that they could meet their minimum threshold, because as a pension fund, they had certain legal requirements that they had to meet. But if it exceeded a certain number, then Ørsted would benefit more significantly from the profits. And the pension fund also lent Ørsted the money to build the wind farms that they needed. And then that converted to equity once the plant was successful and really showing profits. This is a model now that they are using all over Europe, and it's an extraordinary one. Let me give you one other in the environment, because it's different and equally interesting. So the Nature Conservancy, a very well known to all of us large NGO, had been doing their work in many areas of Central Appalachia, in the coal fields of Kentucky and Virginia and Tennessee. And they were working with many communities there. And those communities, first of all, the land was in terrible shape because they were right at the coal fields. Communities wanted to convert to different employment opportunities, and they didn't want to see their pretty towns continue to be environmentally degraded. So very traditional work by the Nature Conservancy going on. It was particularly important because all these towns were right along the Clinch River, which has the largest number of endangered freshwater species in North America. So there was a real conservation issue as well, not only for the land. They raised a $130 million fund from very traditional investment funds of all types. And with that money, they bought 250,000 acres of land. That land they are turning into forest, timber production, and the like. The investor makes their money back through the sale of sustainable timber, carbon offsets from what they're doing, and ultimately from the resale of the land back. And they're predicting about an 8 to 10% profit for the investor. This is like a great fixed income investment that's paying a coupon all the way along. So this idea came from the problem solver side of the community. The first example I gave, the initiative really came from the investor side of the community. But we're seeing all these innovations. We never would have thought that NGOs could create investable products. We know that we have great entrepreneurs. We're investing in them, obviously, at Portfolia. And we have great companies, large public companies. But all these new ideas are flourishing. And again, back to the first question, it really is just another example of how capitalism is both broadening and changing as a result.
Yes, those are great examples. Judith, as usual, people are just jumping in with, a dozen questions here. And so as we talk, I'm going to go ahead and thread some of these in. Elsie Mayo asks, please talk a bit about the challenge of measuring the real positive outcome on people and the natural environment versus investing that is labeled and marketed as ESG or sustainable or impact.
You've asked the $64 million question. And I hope you will buy the book. I don't want to shamelessly shill for it, but we have an incredible chapter there that really focuses on all of the metrics currently in the space. When Rockefeller first got into this field, we decided to fund the initial sets of metrics, both IRIS and GEARS, that are now being run by B Labs and by the Global Impact Investors Network. And both of those were grantees of ours as well. And we said at the time that if we could create a set of easy to implement and uniform impact measures, it would help to accelerate the field. And that certainly has happened. The challenge now is that we looked last year, there was $1 billion with a B dollars spent on measurement of some kind in this space. And it's because there are so many bespoke measures. Some the money managers keep private and aren't sharing. Some are open source. Some are developed by consortia. And it's very hard to really determine at this moment what the quote right metric is. We, in analyzing all the metrics, feel that three things have to happen. And it's a little bit in your question. The first is the metric has to be material. It has to show that what you're measuring matters to the impact outcome and matters in a significant way. And there are some very interesting examples. Y Analytics, for example, which spun out of TPG Rise, uses their metric to really assess three things. One, what does research tell us the impact should be? And so if it's a health investment, they want to look at what health outcomes are the most relevant. Second, how do we assess our investment making a difference that couldn't have happened anyway if we hadn't put our money in? And third, what degree of money should we put in for what degree of impact return? So that's pretty sophisticated. It has a lot of elements to it. And there are others like that, but we're seeing many, many ESG metrics on the horizon. We're seeing Moody's buy companies that do measurements. So they really want to get into the stamp of approval measurement business. The UN has a carbon reduction commitment metric that many companies are using. And then SASB, the Standard Accounting Sustainability Board, which we at Rockefeller and Bloomberg helped to launch, has another set of metrics. So it depends on what investment category you're in. As one sort of vector. And then I would say the second vector is what the class of investment is. Is it in forests? Is it in girls' education? Is it in health? And if you look at then, all right, I'm a private equity investor or an angel investor doing girls' education. then it narrows the metrics and it's easier to find what would be the right one for that particular investment. I'll just say one more thing, Trish, because it's such an important question. And that is, the better investors are using the social and environmental metrics in the due diligence phase, not just in the measurement of performance phase. And so if you want to get serious about it, you really need to rule in and rule out and diligence in a sophisticated way the impact and sustainability side of it, as well as the financial side.
Well, that sounds like an education program that we should really drill down on as well for ourselves at Portfolia. And
that'd be great.
Yes. Let me just toss out too. Elsie Beans, you had the $64,000 question. Emily, I think we have one of Judith's books, a code for that we can give to Elsie to download, and she can actually check out that chapter that Judith was talking about as well.
Great.
And you mentioned B Corp, and at the same time, that question came up from Andrea. She's saying, is the venture world viewing certified B Corps for better or worse? Worse than public benefit corps. So talk a little bit about B Corps and where you see them now.
So B Corp emanated from a nonprofit called B Labs. And initially they worked on metrics, and then through that metrics work really came to believe that they could create a screen that would evaluate companies on their social and environmental performance. It certainly does not do harm to have a B Corp designation. The variables are assessed annually by B Corp and renewed as a designation for any company that's gone through their process. But my own view is that they are too easy a threshold. And so what we're seeing is, rather than companies only seeking B Corp designation, that can be seen as a first step should they wish to do it, but that as the ESG designations, because here we're talking about how companies are really assessed, as the ESG designations grow more and more rigorous, and they are growing more and more rigorous, especially post-COVID, I think we'll see more action and more toughness by coming in through that route, rather than merely a B Corp designation for a company.
Mm-hmm. So Judith, Erika is talking about ESG versus true impact investing. And she's saying, what do you think about negative screen and using ESG factors for investing in public equities? Is that true impact investing as a practice with all the impact washing that's going on? And so there's kind of two questions, right? The difference between impact and ESG, and then what you're seeing here, with the whole impact washing.
I think it's a very significant difference. And so let's make sure that we all understand it. ESG is typically used to assess public companies. That is the screen that many of the money managers have been significantly employing in order either to sell a company as in the impact and sustainability space, or more importantly, to create a fund of funds. So we see a huge number, and that's of course because passive investing has become such a significant mechanism for the retail investor. So between BlackRock and State Street and a couple of others, I mean, they are essentially controlling most of the investments in exchange traded funds at the moment. And so the ESG label there is extremely critical, and examining how effectively they use ESG is going to be very, very important. When you're looking at an individual company, it's way more difficult. So both the Wall Street Journal and MIT published data in 2019 comparing ESG ratings for Exxon and Tesla. And in both studies, they showed that Exxon often got significantly better ESG ratings than Tesla. And on the face of it, that doesn't make sense. But Tesla got nicked for governance more than Exxon got nicked for environment. Well, whose view is that? Who's to determine what the weighting of each of the individual factors of E, S, and G are? ESG is going to change, as I said. It will really grow and expand, and I think that's to the good because of what happened last year. So I do think that what the pandemic showed and what climate change, which is the next existential crisis we need to prepare for, is showing is that carbon reduction isn't enough. We're seeing everybody jump into making commitments to become carbon neutral, and that will not solve our climate change problems. So E is going to expand, and we've been working with some of the entities to try to help them think this through, into how natural resources are deployed, how biodiversity is thought about and re-expanded, and a variety of elements of E are going to be more important. S, certainly what we saw last year is that the social metrics didn't capture how companies dealt with their workers' health or the health of their families. They didn't capture a variety of things that the pandemic really brought front and center. And then G, I think we see a lot of CEOs jump in and make commitments, whether they do it through organized groups that they belong to or signing on to commitments that the UN or others are asking for. But nobody in looking at G has ever really measured in a very tough-minded way whether they're fulfilling those commitments as they continue doing the work of their company. And I think that will change as well as we go forward. It is our view that negative screening is not sufficient anymore, that it's a blunt and old tool, and that newer tools, the ones we're talking about, are really available and much more sophisticated. And I think we're also seeing a transformation in what we mean by activist investor in this space. So typically the activist investor was pushing the company to do better on the bottom line, break yourself apart or come back together, but create more value on the financial side and do it quickly and take a short-term horizon. But we are now seeing great activist investors on the social and environmental side who buy a lot of shares and then really exercise their influence for social and environmental outcomes for the company. And we think that's a very exciting space, and we think it's much more productive than negative screening or dropping the company necessarily from your portfolio. That also may be too blunt an instrument here. Engaging with them, many cases that we go through in the book show how transformational engaging directly with the company is in changing their behavior, changing their products, and changing their business models often. And we think that's a very important approach.
So Judith, Barbara Pierce refers to a recent list of 100 most sustainable companies in Barron's. The focus was ESG. And she said among the top 10 companies, only one, Best Buy, has a female CEO. When you go to the top 20, there are two more, Clorox and Williams-Sonoma, and all of the CEOs in the top 20 are Caucasian. So what about people of color and women when we're evaluating here?
Well, we know the importance of having women as CEOs, and clearly there's lots of very good data showing that women CEOs net compared to males running the same type of company in the same type of industry actually do outperform. So Barron's metric is about sustainability. And why I keep saying impact and sustainable investing is that you can be a sustainable investor without being an impact investor. That was the other half of the earlier question that I never got to. Forgive me. So impact is really about these other domains. whether it's gender, racial diversity, workers' rights, all of these things that really do count so much for impact, but don't figure in the sustainability metrics. And so I think you have to decide as an investor what matters to you most, and then look at those companies or those asset classes that enable you to fulfill them. So let me take an example. We all care about gender lens investing, both as investors and also in as Trish often says, creating the world that we want to live in and we want our children to live in. And so let's say I'm a gender lens investor, but I want a very diversified portfolio. What can I do? Well, I can invest in an exchange traded fund. There's one called Woman, WOMN, that is a market basket of companies that has a very high threshold, very high rating on the Morningstar gender equity set of metrics, which are quite good. So I can have a regular market basket ETF kind of public company category. I can be an angel investor and decide I just want to invest in early stage companies that have women CEOs. I can be a venture investor, such as and invest in Portfolia. And I hope all of you do and will, because that then says I want my venture part of my portfolio put in funds that really will make a difference for women and girls in areas that we care about. I want a piece of fixed income in my portfolio. I could invest in a bond offered by a government or a social agency that's going to invest in girls' education somewhere in the developing world, in a region that I care about. So I could do the same thing across every asset class. I'm just giving you a few examples, but all of it with my gender lens. So there are many ways to approach your investment targets with your values and create value and significant risk mitigation at the same time, performing as well or outperforming many other lens-less investment strategies.
Yeah, that's such an exciting space. And, as Judith said, just looking even at our Femtech fund, and we do have our Portfolio Femtech 2 open, but realize that in 2018, we were the first venture capital fund ever to focus on women's health, which is, right. You take menopause in, over $200 billion market. And there was never a focus on it until 3 years ago. Judith, so many questions coming in. One of them, how do we get impact investing as a course that is offered in all business schools so that we can create a new generation of impact investors?
Well, that was one of the reasons that we wrote this book. We actually, and intentionally, I am a former academic and taught at Yale for 22 years. So really understand what a professor is looking for when she or he wants to choose a book for a course. So we made each chapter a kind of standalone for a lecture or having an expert visitor. And that's why the book is actually organized the way it is. My co-author and I have been really involved in organizations of teachers in business schools where there are both finance courses and social impact courses more broadly. And we've been doing a lot of events with them to really talk about how they could use the book.
Mm-hmm. Very exciting. Now, Barbara Clark mentions, let me get back up here. There's so many questions. Barbara just recently heard on Kara Swisher's Sway podcast, which of course we all love. So if you're not listening to Kara Swisher on Sway, you want to do that. An interview with Mariana Mazzucato. I don't know if I'm saying this right. She says she has a very compelling view on innovation that complements your work, Judith. Are you familiar with Marianne?
I am not, but I will be after this call.
And Barbara, you are welcome to unmute and mention, tell us any more about this.
Please.
Mhm. So it is, let me go back here just a bit. So someone wonders, do we need to worry? This is Deborah. Do we need to worry about publicly held companies going private to avoid ESG disclosures?
Well, they don't go private. They're taken private usually by private equity companies or an individual who's moving in the private equity space. I think if it depends on how it's done and who's doing it. If I turn that question on its head, TPG created Rise. They raised a $2 billion fund the first time. They just completed over $2 billion. KKR, Apollo, several of the large private equity firms who in the past have taken companies private, fired lots of people, stripped them, and then put them back out on the markets, are now creating these funds looking at social and environmental impact. They are transforming themselves from the inside. It's very hard to be a schizophrenic company like that if you're raising all this capital. And I said that the asset owners are asking very, very tough questions. So if that was a practice in the past, and I can't guarantee that it won't continue to be in some sub rosa way, it will be much, much more difficult for them to do so for that reason. And in fact, I'm looking at how TPG Rise investing in entrepreneurs, where the company was never yet public, so private early stage growth companies with the Rise Fund. And they are not only using their sophisticated impact metrics, but to get them ready for IPO, they're also putting them through screens that are ESG screens because they feel they won't succeed at IPO or in the public markets unless they have really strong ESG components, as well as some of these earlier stage impact metrics. So again, a lot of mixing, a lot of sophistication, and a lot of action by actors that we might have been more suspect of 10 years ago in a positive way in molding this space.
Yes, all good news. Well, so Mariah would like us to speak more, talk a little more about the engagement and working with governments and international organizations to get reluctant sovereign nations on board with regard to making investment changes to combat climate change.
Again, I think, excuse me, I think we really are seeing, and it's too soon, we don't yet have enough of a rear view mirror, but I think 2020, when we have the benefit of longer hindsight, will be seen as a real inflection point, because we had many countries who, as part of their recovery package, actually put COVID bonds and social equity bonds and carbon reduction bonds out onto the market as their recovery funds. So they were saying, we're not going to invest our own money. We're going to ask the markets to come in. And if after the markets come in all of these areas, we will invest matching funds behind that. And we're seeing many sovereigns, again, led by some of the Europeans, but the Japanese and others following that strategy. I also think that, again, this is back to where I started, that the sovereign wealth funds will always want some single bottom line investments. By the way, so will university endowments and pension funds. This isn't saying that this is the only way that these mega investors ought to be investing. What this is saying is that this has to be a very significant component of their investment portfolio. And that is actually what we're seeing. But I don't want to say that in order to be good or do well and show that you're committed, you have to change everything in your portfolio to a double bottom line investment. I don't think that's realistic. The other half is also true. There's some social problems that aren't investable, that will always require philanthropy or government assistance or the like. So we don't want to put pressure on governments or NGOs, problem solvers, to feel that they have to come up with some investable business or investable idea in order to succeed. That won't be the case. There was a very good analysis of all of the micro elements of the Sustainable Development Goals by a UN group, and they showed that about a third could be investable now, about a third could be investable within the next 5 to 8 years, and about a third probably would never be investable. Domestic violence against women, or although I could think of some technology innovation company that might deal with that. But anyway, that was their conclusion.
Mm-hmm. So Judith, let's look to the future and hopefully what our newest and younger generations are going to do when they think about money and capitalism, even on a larger scale. And I know you've written a great deal about this in your book and in other of your work. And Lisa asked, about some of the studies showing that women and millennials especially are far more likely to invest for impact. She has a stat where she says that wealthy millennials are allocating assets to mission-based investing has jumped to 28% from 17% just in the last 5 years. Same with women, doubling from 9% to 18%. Are you seeing a difference with the younger generation and the millennials and how they're looking at capitalism and investing?
For sure. And I agree with Lisa. Those data are very compelling, and I expect those numbers to actually grow over time. When we think about, and let's separate for a moment women and millennials, when we think about where kind of conscious consumerism arose, it was on college campuses. I remember when I was president of Penn, and the students all over many universities, including ours, were striking over the use of sweatshop labor in South Asia to make T-shirts and sweatshirts with our university logo on it. So from that momentum and those kinds of movements, we see the young people who have been growing into this millennial category now, and who will have the largest transfer of wealth in history over the next 20 years from their families to them. So they understand that they are stewards of a significant amount of wealth, and they don't want to buy products from companies that they think do harm, or aren't willing to do good, to shift their business models. They're not willing to work for companies that they don't think are really give them pride on a social or environmental basis. And they are voting with their feet. 77% of them, according to a Deloitte survey of a year or two ago, said that in their investment portfolio, they would insist on having a large amount of sustainable and impact investing. And yet until recently, it was very, very tough. And particularly, I think, for millennial women. Many of us know Liesl Pritzker, and I talk about her and her husband, Ian Simmons, in the book, because when Liesl wanted to start investing her significant wealth and talked about investing with her values, her investment advisors thought she meant, I want to give all my money away. And she said, no, I want to make money, but I want to do it with a lens of what we care about and what impact we want to have in the world and the kind of world we want to see. They created a family office, Liesl and Ian, Blue Haven, that's doing only impact investing. We're seeing a lot of that among the millennials, and often that is led by the woman. And so I think we will see more of it. I'm seeing really, really tough questions that they are asking. And I think, Trish, we see that here at Portfolia too. Women really want to understand where and how their money is being used. They're exercising and flexing their financial muscle. And I think that that will expand this field even further. The combination of millennials growing into this wealth, women developing their own categories of wealth. We'll see impact and sustainable investing, in my view, expand way beyond $30 trillion.
Yes. You know, Judith, the Resilience Dividend was such a great book, and you've been such a leader in that space. So who could have imagined, I think you call it it's perhaps a green swan, because, pandemics we knew were a possibility. We just, wanted to close our eyes. But who would have imagined the year we've just gone through with COVID-19 and all? How are you seeing resilience now, and how are we drawing on it? And how do we take that forward to really sustain ourselves and to grow from this?
Well, I just commented on the explosion of metrics and how confusing it was. It is. But I do think, from analyzing what happened last year, that we will need to expand ESG to ESGR, because we have got to be able to assess companies on their resilience as well. And not only their capacity to rebound more quickly and effectively or transform as a result of whatever disaster or crisis next hits, but also to understand the resilience of all of the elements around them. So what kind of transportation systems are there? Do the areas in which they have their offices or warehouses or manufacturing plants, are they vulnerable to flooding and sea level rise? All of these elements, which are going to be very critical in determining both the risks of investing in that company and their ability to withstand a wide array of crises, whether it's a pandemic or climate change related crises, because the one thing that is certain is that crisis is the new normal. And so unless we both build resilience in a very broad sense into our companies and our organizations, and indeed our communities, and then show the capacity to rebound more effectively, we're going to lose money. And it will have a huge impact on us, not only as people, which of course is significant and critical, but also us as investors.
Mm-hmm. So Priyanka asks, she would love to get your view, Judith, on the increasing gaps between the haves and the have-nots, and what role impact investing can play in this problem.
Well, again, that's one of the most complicated social questions of our time. And I don't claim to have the answer. There is no easy answer. And so it will require a fundamental number of changes in our ecosystem in order to reduce that equity gap. And lots of organizations, both public and private government entities, are really, I think, with great intent and with some success, working on that issue. But we do see, and again, as I said, last year was the first year I've seen this, where so much financial commitment to equity issues, not only racial justice, which is so critical, but the gap between the haves and the have-nots, actually are being put into financial structures that we can invest in and produce outcomes that benefit those who are at the lower end of that equity gap continuum. This is not only, government is playing a role. We obviously are seeing last week a huge role that government has chosen to play in the United States, but that is not the only solution. And so we are seeing very interesting investor-led activities to do that as well. There are a lot of bad folks in this space who don't care, who care more about their tax credits and their wealth, and then may salve their conscience by being philanthropists. We're trying to say that this double bottom line investing mechanism is a much better tool than making a gazillion dollars and then being a philanthropist necessarily, but rather how can we blend those goals of social and environmental impact and profitability in ways that are fairer to everyone and may make a more even distribution.
Mm-hmm. And we at Portfolia are looking at, adding other types of asset classes that have, the same kind of commitment we do, so that we can, bring in partners that we believe are really doing the kind of work that, that really deserves further investment as well. Judith, as we look at this, there's so many questions, that are still out there. And this is one thing, friends, that happens every time we have Judith together with us, is that we could go on for hours, if not days. Questions that are coming in, and really the wisdom that Judith has to impart. Judith, as we're looking forward, how can you challenge us? How do we step up, both as individuals and collectively? How can we do our part to make money moral?
I do think that the first question you should ask yourself is, are there investments that I can or should be making that really do reflect my values? What I've tried to show today is that it is such an enormously large space with so many different kinds of investment opportunities, with different kinds of time horizons and different investment scales, that it's hard for me to imagine that you couldn't find some funds or some company or some bond that doesn't really reflect your values. And so, but we hope that it won't be hard work, that more and more and more of these will be visible and made accessible and talked about. We're doing a lot of effort to train money managers, who often are gatekeepers in terms of how people invest their money, to get much more conversant in this space, and really ask that as the first question. When I go to my GP now, he asks me questions about my behavior before he takes my blood pressure. I think when you go to your money manager, they ought to ask you questions first about your values and your interests before they say, oh, I have a great product for you. So it's going to take that kind of transformation, but we're not passive. It's our money. And so the demands that we make, the questions that we ask, the challenges that we are willing to undertake to spend time on this, that's up to us.
Yes. Yes. Well, friends, we're coming up now on the hour. I also want to thank Judith, because she also talked about Portfolia in her book as one of the disruptive and visionary new groups that's providing opportunities to invest in new and different ways. So, and we've got that page, those pages marked all over. But it's Judith has been a board member of Portfolia for Judith. You were our first board member, one of our earliest investors, and as a member of our board and leader in our board, helping us chart our course to make sure that we're making a difference in the world and that we're truly a part of impacting the world with our investments. So I would be remiss by not reminding you all that we do have 2 of our funds that are open. We have 10 venture capital funds, of course, in areas where women make markets, but 2 that are open currently to new investors. One of them, the Active Aging Fund, which is focused, as you would imagine, in the aging and longevity space, which Judith was your early work as well, right? Was in the aging space. And
Yes.
Judith has spoken on that a number of times. And also Femtech, so Portfolia Femtech 2, our second fund in Femtech. And Judith, we also have you're as a board member, you're a board member at Everlywell, and we've had an opportunity to invest in that great company, Everlywell, in both of those funds. So that rapid at-home testing, and the media tells us that Everlywell is now valued at over $1.3 billion. So
Stay tuned.
Stay tuned. We're so excited. So we're able to invest in these fabulous later stage, but still private growth companies run by a woman, the amazing Julia Cheek, as well as really early stage companies in Femtech like Medora, who is providing new solutions for women who've had breast cancer and can't use hormonal therapy, and everything in between. We've made some 70 investments in the last 5 years. So I invite you all to learn more about Portfolia, portfolia.com. And this is where women come together, and our allies and others, to put our money behind the companies that we truly want in the world, that will change and activate our lives. And Judith, I hope you're looking at the chat now. It is just full of people thanking you for your time and your wisdom and your enlightenment. Go to Judith's book, Making Money Moral, which has just been really transforming how we're thinking about capitalism, ESG, and investing. Thank you so much, Judith, and thank you all for being with us here today.
Thank you so much.